Hello and welcome to today's webcast, Speeding Up the Energy Transition Part 2. Please note that we are recording today's webcast and it will be available to watch on demand on our website and our YouTube channel. If you have any questions throughout the session that you would like to ask our panel, please use the Q&A box on your screen. We hope that you enjoyed today's webcast, and I will now hand over to our chair, Bill McCall.
Melissa, thanks very much indeed, and a warm welcome to each and every one of you who are watching us live today during the early part of May, or if indeed you are watching using catch-up at some point in the future. Our two guests today are experts in their respective fields, so I'll turn to each of them in turn to introduce themselves, and then we want to devote as much of the next hour that we have to their knowledge and to understand their views and opinions on this topic matter that we kicked off some 6 or 8 months ago. And boy, has a lot happened since that time. So both Sean and Catherine are here. I urge you to find their full biogs and all of the detail, because we can't possibly cover the deeds of daring do that they have both accomplished in their professional lives. So Catherine, without further ado, firstly to you, a brief introduction for our audience.
Well, good afternoon, everyone. I'm Catherine Porter. I began my career actually in banking, working in capital markets. Then I sort of evolved towards the commodities markets and specialized in energy, and bounced between the trading floors of banks and utilities for a while before setting up my own business 7 years ago. And now I advise businesses across the energy value chain. Thanks,
Catherine. And Sean, from the glorious weather in St Andrews, I imagine, give our audience a quick thumbnail sketch of where you've been and how you've arrived at the hallowed halls of St Andrews.
Yeah, thank you so very much for having me, and it's lovely to be here with Catherine, Bill, and Melissa, and you all. And yes, I'm joining you from St Andrews. My name is Sean. I'm the Director of Policy for the Centre for Energy Ethics and a Senior Research Fellow at the University of St Andrews. And my background is in economics, it's in social sciences, and for the last over a decade, I've been studying commodity markets, so combining my econometrics training with social science training. So the things I like to do is combine quantitative data with speaking to people in the field, so the people that are doing the direct investment, bankers and such. And so this draws early in my career in when I went into retail banking, and then followed through into academia. And yeah, so I spend most of my time looking at energy markets and the intersection with them and financial markets. And I'll leave it at that for now.
Well, thanks very much indeed to both of you. We hugely appreciate your time. And you will know that the Chartered Banker Institute has around 30,000 members globally, not all in the UK. In fact, I would say half, maybe slightly more, are in international places these days. And one of the conundrums that bankers and financiers are facing is how to deal with net zero, how to finance the energy infrastructure of the future, and do we recognize the challenges and the real problems that all of that brings to the table? Because it's not simply a case of doing it. Catherine, you have written and commented extensively on the challenges of the big picture of net zero. Firstly, can we describe or even get to what we mean by net zero, and also your sort of big picture view of the challenges and issues that faces? Now, I know you could write a book on this, but we'll deal with the big picture and then we'll zoom into the micro in due course.
So net zero means net zero carbon dioxide emissions across economies, and that's what the UK government has written into law here. It's an ambitious target because it doesn't just cover the energy sector, it really is intended to cover the entire economy. There are three overlapping challenges with that. One, and particularly when we think about the energy market, one is obviously decarbonisation. The second is security of supply, and the third is affordability. And we refer to this as the trilemma. And the idea is that we should balance all of them. Now, up until about a year ago, for really since the beginning of this century, the focus had been very much on decarbonisation. And this is true in pretty much all markets globally. It wasn't just a British thing. Here in Britain, Obviously, at the turn of the century, we were a decade into privatization, and we were still benefiting from the investment overhang from the central electricity generating board, arguably having overcapacity within the generation sector, which allowed the early years of privatization to look extremely successful because there wasn't that need for capital investment at the time, and it meant that it kept costs down for consumers. Once we moved into this decade and began the energy transition, we saw consumer costs starting to rise, reflecting the cost of subsidizing renewable generation and integrating those renewables. In Britain, we're now spending £10.5 billion a year on legacy subsidies. And obviously that was starting to pose challenges for affordability even before gas prices took off in September 2021. Since that happened in September 21 and then the invasion of Ukraine the following February, there has been quite a significant change in emphasis from policymakers around the world, and a much stronger focus on affordability and energy security. The energy security interest is largely focused around gas, because obviously the desire to move away from Russian gas, also other Russian hydrocarbons in particular, oil and coal, but gas has been the main focus. But underlying that, there's also an electricity crisis, which has been policy driven. It happens to be the fact that we've coincided a point in our development of renewables where we're beginning to threaten energy security because we're retiring conventional generation and replacing it with intermittent generation without really taking care of what happens in the gaps. And so suddenly all of this has sort of come to a head in parallel with the gas prices that were stimulated by the invasion of Ukraine. So it's interesting that now we're starting to reach a point where we have to look again at our investments in hydrocarbons. When we look at the way that investors and lenders have been approaching this question in the past few years, there's been a very much anti-fossil fuel focus, and a pretty sort of one-dimensional carbon reduction approach to the whole topic of ESG. I think we're starting to see a little bit more nuance now in that conversation, partly driven by concerns over outright returns and partly driven by concerns over greenwashing, both of which have really gone up the agenda recently. And that needs to continue. Investors need to take a more multidimensional approach to projects and think about all of the consequences, not just the carbon impact. There's some school of thought that if we have high oil and gas prices, that will stimulate substitution and investment into substitution. That might be true in the long term, but it's really not true in the short to medium term. All it does in the short to medium term is cause hardship, particularly for people on low incomes. They have the direct energy struggle to manage to afford their energy costs, but also it drives costs up across the economy. Supply chains costs get higher, and this covers pretty much everything that they have to buy and pay for. And there's a strong correlation between high energy costs and sort of wider economic downturns and recessions. So there's a real need, I think, for refocusing on making sure that we can replace hydrocarbon assets that are expiring, and recognize that nobody is forecasting that we're not going to need oil and gas by 2050. So if we don't invest in new E&P, then all that's really going to happen is that we're going to have high energy costs, and that's going to be very negative economically.
Thanks, Catherine. I mean, that position will come back to you, and I may ask you to unpack the idea of that trilemma, because that's something that we're living with in the UK context. Sean, turning to you, as an academic, but you also have this commercial world that you've come from, so you must be quite unique. In that you have a commercial angle on your academic work. What do you see as the big picture challenges as an academic within the policy group you lead at St Andrews? What are the big items that you and your colleagues are considering at the moment and looking to find solutions for?
Yeah, absolutely. So we're at the Center for Energy Ethics, and so this is our key concern is how do we ethically balance rising energy demand with concerns about anthropogenic climate change. And this is something that we talk about all the time. Let me just paint sort of a global picture of where we're at. And let me, if I can share my screen, that way you're not just looking at me, you can also look at if I can find the right tab. Can you see my screen okay?
Yeah, we can.
So right now, there is a global energy transition happening, but it is happening slowly. And the transition that we're really seeing is from coal to natural gas, very much in line with what Catherine was saying. So, for example, we see 56% of the energy that the world depends on comes from hydrocarbons, followed by hydroelectric at 13%, wind and solar at 12%. So you can see the world is still very much dependent on hydrocarbons. And while we've seen a remarkable growth in renewable energy technology, as you can see here, led by East Asia, followed by Western Europe and North America, the world is still really dependent on hydrocarbons. And we don't really see this changing anytime in the short term. So while most countries, the energy mix of most countries, including the UK, varies a little bit, the picture overall tends to be a very hydrocarbon dominated one. So let's focus in on just the UK, the US, and sort of the global picture and some of the dynamics that we've been looking at, and some of my colleagues and I are looking at. And I'm going to bring up some of the complications and ethical considerations that financiers and bankers are currently considering right now. So, for example, 85% of households in the UK depend on natural gas to heat their homes. As of this morning, between 5 a.m. and 10 a.m., somewhere between 39% and 56% of our electricity was generated from natural gas. So what this speaks to is the dependency on hydrocarbons that we currently see. In the US, we see a much different picture. About 44% of the natural gas that we get here in the UK comes from the North Sea and East Irish Sea, and the rest of it's imported. US, much different picture, much different investment climate. So what we've been seeing since the early 2000s, there are people in the US, companies in the US investing in oil and gas production, as well as renewables, but oil and gas production in particular. And what I'm talking about is unconventional extraction. This would be fracking. And so it's no surprise then that as of last year, the US was the largest exporter of LNG in the world. And actually just last month, it was at max capacity. So 70% of this LNG coming out of the US is going to the UK and Europe, with another 12% going to Asia and rising demand coming out of Latin America. So there is an energy transition, but again, this is a transition to natural gas and not so much to renewables in the way that we often hear in the sort of media and such. Now, this is kind of an interesting picture because natural gas has historically been a regionally traded commodity. And while LNG has been around for a little while, it's only recently become a globally traded commodity. And this has been expedited by the war in Ukraine, Russia's war in Ukraine, and because the US has been making substantial investments in LNG export capacity. Now, for bankers specifically, the picture is a bit nuanced. So, for example, a recent survey by the law firm Haynes Boone of major energy lenders in the United States suggested that most lenders are looking at, in the next 24 months, US natural gas prices to rise by about 20%. And they're expecting oil prices to fall somewhere around 8 to 10%. There is strong sort of emphasis on the potential for renewable energy to be invested in. But from our perspective, well, what we're seeing here at the Center for Energy Ethics is that we agree with Catherine that, there needs to be a smart energy transition in terms of if we are going to transition away from fossil fuels, there needs to be plans in place to make that transition happen as smoothly as possible, and also to take into account changes in the market, like we saw with this invasion of Russia into Ukraine. But there's actually another piece to this that I think financiers should be aware of. Some of our colleagues here at the center have alerted us to, potential medium to long-term challenges with renewables. And I'm thinking about wind in particular. Thinking about demand for copper and the amount of resources available of copper, this is a major challenge for renewable energy production. If you look at the most rare earth minerals, we can see them located around the earth, but the most rare earth minerals, the most important ones, come from about 3 mines in China. And so we can think of major supply chain problems coming up in the medium term. So I can expand on this. We see some, major changes in the North Sea, major changes in the US. And so I can paint some more detailed picture in the Q&A, but let me turn it over for now.
Well, thanks, Sean. Thank you for that. The graphic is helpful, and we'll make that available. It will be available in the recorded version. Catherine, just to come back to the UK, and we will zoom out, as it were, to look at the issues around the Gobi Desert and the turquoise mine. That's the biggest copper mine on the planet, I guess, at this point. RTZ are trying to do things. It was something you said earlier. Is the UK then in denial, in your view, Catherine, around this trilemma? And do we have policymakers who think the switch is as simple as taking one step to make the switch and simply aren't facing up to the harsh reality of the difficult journey between here and there?
Yeah, and I don't think that's unique to the UK. I think that's across a lot of different countries. We're seeing a lot of naivety around this, and also the impact of some pretty self-interested people who benefit from subsidies and therefore deliver a particular line. We've heard in the past year a lot of people putting forward the argument that the answer to high gas prices is more renewables. And that irritates me a great deal because it simply isn't true. Right? On a short and marginal cost basis, yes, renewables are cheaper than gas and just about everything else. But the all-in cost to consumers, that is not the case. And if you look at what's happened with prices in the first 20 years of this century, you can see that gas prices just followed whatever they were following. They did their particular thing. Electricity prices just end user electricity prices just consistently went up. So there was no real relationship with wholesale gas prices. And this is because there's a huge amount of other costs that come along with it when you're developing renewables. You have to subsidize them, you have to connect them that tend to be built in places that don't already have network infrastructure. If you don't do that quickly enough, you then have to pay curtailment fees, and balancing costs go up an awful lot because you've always had a lot of variability on demand, but now you're introducing a huge amount of variability in supply as well. And that is hard and expensive to manage. So and also you have to pay for stuff to be available when it's not windy and sunny. So you're subsidizing conventional generation as well. And all of this adds up. And all of it has to be taken into account when you're looking at this question of the transition. So policymakers, I think, have been persuaded to believe some pretty simplistic arguments that just really aren't based in fact. And it's very nice and easy to have simple arguments. Carbon dioxide is bad as a simple argument, but it's not necessarily a good argument because yes, it might be bad, but it doesn't mean that other things aren't bad too. And you can look at something like electric cars. A lot of people think that electric cars are self-evidently better than conventional cars, but this isn't the case. They take an awful lot more resources to build. The embodied energy is a lot higher. You have to drive an electric car for about 60,000 miles before you break even with a conventional car when it comes to embodied emissions. Now, in my personal case, I don't actually have a high mileage, so I'm likely to die of old age before I get to 60,000 miles. In which case, actually, for me, buying an electric car would be very bad for the planet. And so we need to look in a much more sophisticated way about these things. What's been happening with policy around many countries, we've been seeing this in the US as well, the ball has really been dropped on security of supply. There's been this push for renewables, overlooking the fact that it's not always windy and sunny. It's not sunny at nighttime. It's amazing how often that needs to be repeated. And the winter peak of demand happens after sunset. So you get zero contribution of solar at the point when you need it the most. And if you have a high pressure weather system in the winter that delivers still weather as well as cold weather, it's wrong way risk. And the assumption was always, oh, we'll just import our way out of trouble. And we found that doesn't work either because we have high weather correlation with our connected markets, and most of them are following a similar energy transition to us with a strong reliance on wind. And so that being the case, they might also want to import at the same time that we do. And you can easily come up with a scenario where on a regional basis across Northern Europe, you're actually short. And prices are high across the entire market. And this is leading to a resurgence of energy nationalism, which has been quite a strong theme in the past year.
So even the mild-mannered Norwegians who have a significant sovereign wealth fund, so they have the wherewithal to invest in the infrastructure, have pointedly told their German neighbours, near neighbours, that they wouldn't be exporting the same sort of power capacity that the Germans would like. The UK at one point has been actually shipping electricity, well, not shipping, but through cable to France. So that there have been, but you're right, the geographic approximation of those countries, we're all facing broadly the same weather at roughly the same time. I wonder then, is it because policymakers are thinking we can't handle the truth? Or is it the simple argument is the thing that gets them elected? I'm not looking to stray into the world of politics, but I'm wondering why the complexity that you've explained is not something that we are all talking about. Why do you think that's the case? It seems to be that the general discussion around this is renewables good, hydrocarbon bad, so it's quite simple, stop doing one and do more of the other. The complexities and nuances you've mentioned, why are they not in the mainstream?
I think part of it is that politicians themselves struggle to get their head around it. In Britain, if you look at who are our politicians, there are very few people with a science background in politics or in the civil service. And so you've got people with humanities backgrounds primarily, and they're just not equipped. They just don't have the training to do the type of hard analysis that you need to do when somebody comes and says to you, oh yes, we know renewable generation is cheap and it's going to save the day, to really question that. I was looking at some figures just the other day, and it was saying to build a 1 megawatt offshore wind turbine, you need 15 tons of copper. And so pretty much everything that we use is either grown or dug up. And digging up mining is a hugely polluting, very un-environmentally sustainable activity. So in our sort of one-dimensional obsession with carbon dioxide, we're going to cause other types of air pollution. We're going to cause water pollution. We're heavily utilizing things that are being produced with child labor and forced labor. There are really significant ethical concerns around everything that comes along with the current narrative that are just being completely glossed over. And I wouldn't be at all surprised to see an electric car reversal in the same way we had Dieselgate. 1 minute diesel's amazing, it's being subsidized, and the next minute it's the devil, and we've all got to move on. I could see something similar with electric cars, because actually we shouldn't be relying on 11-year-olds to provide key minerals. There are conflicts in South America over access to water because lithium processing is very water intensive, but that water is also needed for agriculture and human consumption. So, how do you balance all of these things? And it's not necessarily the right answer to get rid of fossil fuels at any given point in time. And sometimes fossil fuels are better than the alternatives, which is also something that people don't seem to consider.
So I wonder, Sean, one of the questions that's being raised is, and I will mention at the end where we think some of our viewers today can pick up decent data and background information to talk to their clients about this kind of thing. Because informed bankers is one of the key aspirations that we have in educating our membership. Sean, from your perspective, there is a question that could say, well, who in the world is doing it right? Who's getting it right? Who are the exemplars? And of course, the caveat there being that not every country is the same, population, economics, and everything else. But when you cast your eye around, I know that you're particularly interested in the fracking market in the US particularly, but who do you see is perhaps leading the way that we might learn some good lessons from? Or is that just too simplistic an argument?
Yeah, let me pick that up. So let me preface by saying that there are no easy answers. I think that might be the message that comes out of this. And so we can look at various jurisdictions around the world, but what we find is that it's based on a region by region basis. People will use the energy that they have access to. So we see major coal producing regions that don't have access to other resources use coal. Major hydrocarbon producing regions that don't have access to other resources use hydrocarbons. If you have lots of hydroelectricity, that tends to be the electricity that you use, looking at in countries in Latin America, looking at Norway. So I think it's a region by region story. I think some of the interesting things that we're seeing happening right now, and this speaks to perhaps my regional interest in the United States, is the transition we're seeing happening in parts of the southern United States, in particular in Texas, where they seem to be taking a dual strategy. So of course, it leads the United States in terms of oil and gas production because of unconventional extraction, but it is also one of the leaders for renewable energy technology. And so it seems to be taking a sort of, we'll take everything all above sort of strategy, which other parts of the United States don't seem to be doing. I think there are a couple pieces to that. One, because of the geography of that particular place. It has a lot of open space in West Texas because of land and zoning laws. And so I think the answer is going to be a place-by-place answer. And some of the major challenges, what basically we see with every major challenge, with every way we produce energy, is getting it from the point of production to the point of consumption. This is the case for hydrocarbons. This is the case for renewables. So for example, the US has typically either vented or flared natural gas. The main reason is because they couldn't make money getting it from the point of production to the point of consumption. As demand for natural gas has gone up, they've put in more infrastructure to export it as LNG because there wasn't enough of a domestic market. It wasn't profitable for them to absorb that. We see a similar phenomena happening in the North Sea, for example, in two respects. We see a large demand for wind turbines offshore, but the infrastructure doesn't exist in its current form to take that electricity from its offshore location and get it to where people are demanding it. In the North Sea also, what we're seeing is that as super majors, and super majors really are, set the tone for our larger energy environment that we find ourselves in terms of how they're investing in oil and gas and renewables and such. And as they turn over plots of land, either in the North Sea or parts of the United States, divesting from those sort of legacy oil fields to go after those bigger whales in deep sea, we're seeing some independent operators starting to move into places such as the North Sea to try and revitalize those legacy oil fields. But some of the problems they're having is connecting with infrastructure. So for example, the majors have major underwater infrastructure. It is, they've been using tiebacks much more. So this is the idea that they drill a well, they don't necessarily have to have a platform above, but they can tie it into their existing infrastructure. This is something that independent companies can't do. And this is a phenomenon that we see not just in the oil and gas market, but also with renewables as well. So so to answer your question, it's complicated and it's a region by region answer.
Yeah, and in the US, let's just stay specifically on that. There is a cardinal sin, I guess, we make that the US, we consider it to be a generic marketplace. You've described quite clearly the disconnectedness from the West Texas wind gathering energy with, say, the Northeast, the Boston region and up towards Maine, where there is a disconnect in those regional markets simply because of geography and infrastructure. Catherine, I wonder then if we draw that back to the UK, that we've got constraint payments being made to a number of wind farms in the UK. Some of them are very far removed from the centres of population, which is predominantly southeast of England. All you need to do is look at an overnight satellite picture of the UK and you can see where the power of the population is. So Catherine, is that dispersed, the energy being in the wrong place and the infrastructure not being sufficient, is that a problem that we face too?
It is, and actually we're very similar to Texas in that regard. A lot of our wind generation is in the north. In Texas, it's in the west, and our industrial demand and all our demand really is somewhere else, which is also the case in Texas. Most of their demand is on the Gulf Coast. And you really can't do a great deal about that. Wind farms should locate where it's windy. That's the most efficient place to put a wind turbine, is where it's windiest. People make choices about locating demand based on a lot of factors, and in electricity costs are not really the main one. Even energy intensive industries like data centers, electricity costs are only their third most important consideration behind telecoms, connectivity and availability of staff. And neither of those two things are particularly available in the north of Scotland. So there's just no possibility really that we're going to relocate data centers up to the north of Scotland. In the same way that in Texas, they're not going to start moving LNG liquefaction plants away from the Gulf Coast and moving it inland in West Texas. That's clearly not going to happen. So we have to accept the reality of how our markets work, how our economies work. Is why I'm quite strongly opposed to locational marginal pricing, because they have that in ERCOT and it just doesn't deliver. They have significant issues with network constraints and insufficient network capacity. In Texas, the same way that we do in Britain, moving to locational marginal pricing isn't going to change that. You're not going to persuade demand and generation to co-locate in any meaningful way. Because simply electricity costs are not the main driver of the economy in that sense. People don't put them at the center of their business decision making.
And sadly, some of the other constraints to the decision making are often allied with that very same argument that electricity prices are not number one, but connectivity is, and infrastructure. And quite often, sadly, the areas that are blowing the most wind are the ones that are least populous for obvious reasons. So it does strike me. Now, there is a question from our audience, and it's the old question of, well, don't we just create batteries to store the excess energy when it's not being used? And I merely think back to a 4-day fire in Australia with a big battery. I think it was called the Big Battery Project. It ignited. I also know from data from London Fire Brigade that one of their concerns of late has been the number of unexpected fires created by discarded lithium batteries. It's one of the big issues they've got. So, Catherine, surely it's just about inventing a battery, a big one.
So first of all, I'm really happy to hear you mentioning fire risk. It's something that is really neglected within the energy industry. And you see, like TfL has banned, so for people not in the UK, that's Transport for London, has banned electric cars and electric bicycles and electric scooters from any of its modes of transport because of fire risk. If you've got a mechanical scooter that you just push along, that's fine, you can take it onto the tube, but you cannot take an electric scooter on the tube because it might catch fire, and that would be catastrophic. There are a lot more house fires as well, and particularly because people put their electric scooters and electric bicycles in hallways, and so that blocks the exit routes. There was a big house fire in Germany not long ago, and the fire was so intense that it actually activated the solar panels. The fire brigade turned up. There was an electric car in the driveway, and they couldn't tackle the fire because of the electrocution risk, and they couldn't find the isolation switches. They ended up having to go down the street and turning off the whole street at the junction box rather than just being able to isolate the house. So it's a really big risk. When it comes to managing intermittency, the big issue you have is duration. So lithium-ion batteries are not really very good for this, and that is the main technology, pretty much the only technology in town at the moment. A lithium-ion battery will last on the grid scale between 1 and 4 hours, and the average is 1.5 hours. And so you cannot say that a 1 megawatt battery can back up 1 megawatt of wind generation, because it can only do that for an average of an hour and a half. And you can find low wind conditions persisting, not just for hours, but for days or even weeks. If we look back to July and August last year, we had, for the best part of 2 months, low wind. We had periods within those 2 months where wind did pick up, but the still times were long. We were talking days and many consecutive days of low wind. you just cannot manage that with chemical batteries based on existing technology. And somebody did a study on this, and I think they concluded that we don't actually have the land mass in Britain to install the amount of lithium batteries that we'd need to be able to do that. So the real answer is we need to invent long duration storage. And practically speaking, that doesn't exist. The best we can have is hydro, pumped hydro, but that's not really long duration. So, and also you need to have appropriate sort of geographic features, and it has very high capital costs. We don't really have the right geography for a lot more hydro in Britain. There are other countries where you could effectively do more hydro. You could, in Norway, in Central Europe, with the Alps, you probably could do more than they currently have, but it's not really a huge option in the UK. So we really rely on gas, because gas is the only technology that has the flexibility to back up that intermittency until we come up with storage technologies that can do the job, and that just doesn't exist right now.
And that chimes with Sean's point that dispersed geographies tend to focus on what's available in the near geography. So if it is gas, it's gas. And on our previous webinar on this topic, we had a very eminent academic turned commercial individual who talked about fusion, because that was his area of interest. And that's a long, long way away. I know there was whooping and cheering earlier this year because an experiment happened and everything else, but we're not going to get into that because it's in a galaxy far, far away. I know it's May the 4th later and Star Wars Day, but not today. Sean, hearing that particular point, if you and your colleagues at University of St Andrews had the ear of policymakers, what do you think you would be talking to them about that they should be considering, given the field work and the expertise that you're drawing around your table? What would you be telling them?
A couple of things, and in fact, we are telling them. So we have and continue to make policy submissions to the Westminster and Scottish governments based on the work that we're doing. And I want to emphasize that, you know, our strength is in our interdisciplinarity. So I work very closely with physicists, chemists, geographers, rare mineral scientists, economists like myself, trained in an interdisciplinary background, to think about how we can get around and think about these problems. And one of my colleagues, for example, is working on exactly this storage question. How can we rethink storage? Are there other technologies that we can use or employ to make our energy storage more efficient, more flexible? And see, these are the people that are working in physics and chemistry. Some of the things that we have said and continue to say that, you know, when considering the broader energy ethics that we find ourselves in, with rising costs, with increasing energy demand and increasing concerns about anthropogenic climate change, is that we need to be flexible. That if we want, we're not saying that there shouldn't be an energy transition. There's clearly political and popular demand for an energy transition to reach net zero. We hear this a lot, but we need to do it in a smart way. We need to do it in a way that takes seriously people's concern about the rising cost of energy bills, and to not just make ourselves reliant on one source of energy. So for example, in the last 20 or so years, we have been very dependent on a few sources of natural gas into the UK economy. At the same time, we've divested from natural gas storage facilities here in the UK and storage facilities that the UK has possessed in other places.
So the rough storage that was given up. Yeah.
Right. And so one of the recommendations we made to the UK government was, one, perhaps this is not something they should have done without putting other infrastructure in place to have that storage capacity in some way or one shape or another, but also to think about the infrastructure that we're putting in place right now to make it flexible. So if you're going to put in natural gas pipelines, make sure that maybe perhaps they can do natural gas as well as hydrogen if in 10, 20 years we are going to switch to an increasing blend of hydrogen, which some of the scientists at the center are currently working on. And so this has been our overall sort of message, is that we need flexibility, both in terms of our infrastructure and in terms of our markets, and to think, about the broader ethics that we find ourselves in, what people are asking for, and to take seriously people's just their everyday, day-to-day lives and demands in terms of how much they're paying to turn on the lights and heat their houses, as well as these sort of broader geopolitical concern, as well as geological, I guess, but geopolitical.
Yeah. Catherine, I know
I was
that
going to
it's
say, could I
a
just
topic
jump?
you're going to probably talk about the inefficiency of the UK housing stock, which I know is something you've written about, that it's all very well heating properties and everything else, but isn't the UK in a tricky position with the quality of the housing stock in terms of its fit for purpose nature?
It is, but if I just could go back to a couple of things that Sean just commented on. While I don't disagree that we need flexibility, I'm yet to see an analysis that demonstrates that the money spent on gas storage would have been worthwhile over the past 18 months. If you look back to 2016, when Centrica closed Rough, the wells needed redrilling, and that was going to cost about £1 billion. Now, I haven't seen anybody put together a credible analysis to show that £1 billion would have paid off in the time since. And so I think we need to take account of that. Gas storage is very capital intensive. And it's all very well saying, we need the flexibility, but it's like you wouldn't insure your house if the premium was the cost of a house. And so you have to make sure that the costs are reasonable for the benefits. The other thing that I would like to mention is the changing nature and I suppose, fickle nature of what people want. So back in November 21, when we were hosting COP, pollution and climate change was the number one mentioned topic in the Ipsos Mori Issues Index for that month. And then second was COVID, and then Brexit, and then the NHS, and then the economy. In March this year, the number one is inflation, then the economy, then the NHS, then immigration, then lack of faith in politics and politicians, then Brexit, then poverty, and then environment. So basically, public interest in it has dropped by a factor of 4 over that period. Now, obviously, at the time of COP, it was very much in the news, and so people were probably more interested in that particular moment than on average. But it's very much dropped down the public's priorities right now. It's all about.
So we are terribly fickle hypocrites, and politicians whose job is to be re-elected and be popular will clearly follow that listing more than they will long term. They don't see beyond the 3 to 5 year time frame, I guess, is the issue. To go back to the Rough project, so the $1 billion of capex that would have been required to simply bring it back to a point. Can we flip over now to Russia? Because I know you've covered this quite well in the past. There are some Russian gas wells that, if they are shut in, because Russia will not be able to sell its gas anywhere and move it around, that will reduce their capacity. Perhaps you could just enlighten us about that specific point, and I'll go to Sean for a further comment.
Yes, that's true. I mean, the Russian infrastructure is very much oriented towards Europe, and most of its production is oriented towards exporting into the European market. Since that market has largely dried up, hasn't completely dried up, there's still pipe gas coming through Ukraine and through Turkstream, but Nord Stream is obviously completely out of action, and Yamal Europe hasn't flowed from east to west in a really long time. So functionally, there's much less pipe export into Europe from Russia. Now, some of that can be diverted into LNG and has been, but very little of it can go into Asia, really, unless Power of Siberia 2 is built, that would connect the European-facing infrastructure with the Chinese market. Then those assets risk being stranded. Gazprom prioritized filling Russian domestic storage over last year and pretty much filled it all up. And so was looking at a situation at the beginning of winter where it was going to have to start thinking about potentially shutting in some of those fields. Now, obviously, then you have winter and that changes the dynamic, and winter's not really over in some parts of Russia yet. So, but yes, once those fields get shut in, then they would have to be re-drilled as if they were new fields to bring them back online. And that's obviously a huge amount of expense. But there's not really much other option. You know, if Europe won't buy the gas and it can't be sent somewhere else, then you're going to have to just leave it where it is.
And therein lies the parallel with the North Sea, where if hydrocarbon assets are left behind, stranded, because financiers or legislation or whatever it may be means that they will not be got at. We have a similar situation. Now, I know that you've covered that quite extensively also, and also the windfall tax noise around all of that. I mean, BP's profit yesterday of 4 billion or so, 1 billion of which coming from trading, yet Saudi Aramco making one of the biggest dividends the planet has ever seen. No windfall tax there. So are we just very hypocritical? Is that the issue, Catherine?
Well, I mean, we are, and also we risk having the perfect being the enemy of the good. I was interviewed by the BBC yesterday on this topic of BP's profits, and they were saying, you know, is it fair that BP should make all these profits? And to a certain extent, I don't think that's the right question to ask. There's plenty of stuff in life that isn't fair. Is imposing a windfall tax to try and address this fairness question actually in our best interests? And I believe that is no, because in BP's case, most of their activities are not even in the UK, so they're not subject to the windfall tax anyway. And it is harming investment in the North Sea. Nobody thinks we're going to stop using oil and gas. So if we don't produce it ourselves, and I mean in the next decade, you know, in a meaningful horizon. So if we don't produce it ourselves, we'll have to import it. And that is not only economically disadvantageous, it's also environmentally suboptimal, because you have the emissions from transportation, but also you lose control of production emissions. You know, we can decide what standards we're going to set for North Sea production. So I think that we're in some ways coming at this the wrong way. We should be less concerned about, is it fair or not for a company like BP to make high profits at certain points in time. Also keeping in mind that, you know, they have bad years. Energy is very cyclical.
Lost 20 billion not so long ago.
They lost a lot of money pulling out of Russia. They, you know, 70% of exploration wells come up dry, and nobody receives compensation for that. And working in upstream oil and gas is one of the most dangerous activities you can possibly imagine. So when people say these profits are unearned, I take issue with that, and I'm sure anybody that has friends and relatives working offshore would take a similar view. So I think we need to really think about what's in our best interests and be less hung up on this question about fairness. It's irrelevant whether it's fair or not. Life isn't fair. What we need to look at is what's in our best interests as a country, and do that.
So we have politicians looking for a fair and just transition. And when you ask, it's quite difficult to understand what they really mean by that. Sean, from your perspective, looking out from your window, what would you be concerned about over the course of the immediate term? And that's probably the next year or two, given that we have a land war raging in Central Europe. What would worry you then? And then if you were looking beyond that period of time, what would you be interested and concerned about, say, 2 to 10 years from now?
Yeah, let me address that. But let me just come back to and respond to Catherine, then I'll get on to that. So just very quickly, absolutely, I agree that people's minds change, but we don't see that, climate change is going away as a general concern, and certainly people's priorities change, especially in the last couple of years with rising energy costs. With the RUF facility, yes, it was expensive. Doing oil and gas has always been expensive, but the question is should we have this sort of storage in place in the UK? The UK has the lowest amount of natural gas storage in all of Europe. Should they have done something in places? What is the cost of energy security in the UK?
Yeah, but that's not the question. It's not the question.
No.
Cost
Sorry.
of energy security is
And then-
the cost of
sorry,
developing storage.
I'm
So,
No.
so well, Sean, you answer. We're not going to open that up to debate. Sean, you continue your line of thought, and I know what Catherine will get to. Okay.
No, absolutely. And then yesterday I was talking with my colleagues at energy intelligence firms about the BP profits and the windfall tax. And yes, BP has paid $1 billion in taxes on North Sea profits since the windfall tax was introduced, and they announced $5 billion of profits. But when I was talking with energy analysts in the industry, I said, has this changed the investment decision? And they said, not really. No one's really made a credible argument that oil majors have changed their investment strategy in the North Sea. What it is affecting, though, are the independents working in the North Sea, but not necessarily the major oil companies. For example, I was in a presentation with one of the VPs of a major oil company, and when they put up on the screen where they make the most money, it's offshore, deep oil, not in the UK, it's other places. It's off Namibia. It's not really in the North Sea. These are really
not anymore. I mean, Sean, the North Sea. The North Sea argument was over 20 years ago, when the super majors, the international corporations decided to exit, and they were selling their secondary assets to the up and coming challengers. So yeah, the North Sea still has an entrail of it, and we get hung up about it because it's on our doorstep. But if you look beyond the UK, the US is almost self-sufficient, albeit it's not all in the right place, and we've got geographical issues and outages in California and everything else. The Strategic Petroleum Reserve in the US has been run down significantly in the last little while. Is that telling us that because of the fracking world that they now live in, they no longer see the need for a massive Strategic Petroleum Reserve, do you think?
No, I don't think so. I imagine the strategy that they put forth and that I've heard that they are actually pursuing. So I think there's a difference between what they publicly announce and what they're actually doing. But what I understand from everything I've heard and both public and confidentially is that they're expecting to replenish that. But for the moment, it was a public policy decision to run those down. And that seems to be consistent, that we don't see that they're going to be run down in the long term. But right now, yeah, so I think they have their mind to energy security. Right now, their biggest energy security problem is not crude oil per se. They're in a very good position. Now, this is a regional problem, of course, because of the way the US is made up with regional jurisdictions, state laws and such. So some parts are perhaps more energy secure than others. But as the United States as a whole, given that sort of checkered picture, the US is in a very good position. Energy-wise.
So one wonders how long they will continue to pay the cost of being, say, the global policeman in the Middle East, when they perhaps have no need to protect assets or significant assets anymore. Now, we are coming towards the end of our hour together. I did say to our guest speakers today it would be the quickest hour of the week, and I know from Melissa's perspective from the Institute that it has flown by and there have been no significant issues. Now, Sean, you've been ploughing a furrow to write a book about the very topic that we just ended on there, which is the US energy market. So we wish you well with that. Perhaps you might just give us a heads up of what the likely timing of that would be, because I know that there will be those who are keen to understand it.
Yeah, so that should come out next year, and it's on. It's called Carbon Capital: Financial Cowboys and Ethical Oil in an Anthropogenic Era. And it's about how the power of direct investment. So how direct investment can change our energy world. And it's looking at how billions of dollars were put into US unconventional extraction and changed the face of the energy world in the United States and the world over. And I think it really speaks to the power of financiers and how financiers can shape our broader energy worlds. So
something like $1 trillion put to work over a 20-year period or thereby, and the world has transformed. It has transformed the US energy picture for sure. There's no doubt, and seems to be continued to do so. Now, Catherine, I can't believe that it's 7 years since you started to write things down, thinking that you would keep your mind alert and some people might be interested. And you now have a significant following online with your blog, and you are a regular commentator on various media outlets. And quite often you've said The smart people understand it, but you sometimes get complaints from those who don't like what you say. Will you be continuing with your informative writings? That's one thing. And I'd be pointing our viewers today and those who are catching up on catch up to follow it. So what drives you to do that? Because you're looking at a blank page every now and again. How do you motivate yourself to make the blank page turn into a few thousand words of really important stuff?
So that's not how I look at it. I'm constantly being exposed to ideas and things that I feel that I want to dig into a little bit more. And so I use my blog as a way of doing that, either because it's coming up in part of some client work, or just because I've come across something that I've seen. You mentioned fusion earlier. I was on a panel with Ian Chapman about a year and a half ago, and he was enthusing about fusion, and I thought, I haven't looked into this for a while. And so I went away and wrote, researched where we were with fusion and wrote a blog about it. I was a lot less enthusiastic having done that than I was after listening to him, but there we are. So it's I don't struggle for topics. I struggle for the time to actually put them down.
Such is the life of an analyst, Catherine. You do it because that's just the way you think. Well, we only have a few minutes left. There is some housekeeping. So firstly, I'd like to thank both of our guests today. I'm sure if you're watching this in real time or in catch up, you will have been incredibly impressed with the depth and width of knowledge that each of our speakers have had across a panoply of subject matter that ranges from the US to the Far East to the UK to energy security and various other things. We could have a longer series of these discussions on specific topics. The important thing for financiers and bankers is to understand where they fit whilst dealing with ESG matters and dealing with the public demand for climate change to be managed. All of that is shades of grey. There are no right and wrong answers. And policymakers would be wise to listen to people like Sean and Catherine. Coming up over the course of the next month, the Chartered Banker Institute will host its 148th annual general meeting on the 22nd of June. That will be in person and online, so a hybrid meeting to allow some of our 30,000 global members to attend from whichever time zone and part of the world you're in. And even bankers like me will have worked out that 148 is only a couple of years away from our 150th anniversary that will be coming up in 2025, which also chimes with our charitable foundation, the 2025 Foundation, where we hope to encourage and cajole and coach people who ordinarily wouldn't find a career path into finance to do so. And that is work that I would commend to you. So from Catherine, Sean, and great deal of thanks to Melissa Law at the Institute for putting all of this together. She did all of the hard work. All we had to do was turn up and chat. To each and every one of you, a safe day. The Institute AGM will be on the 22nd of June. And until next time, thank you very much indeed for joining us.